We talked yesterday about the difference between the cost of goods index and the cost of living index and how the numbers have been manipulated. So to hear that the old way to calculate inflation would be over 14% is pretty powerful. When you combine that with all of this negative yielding debt, what is the event that ends that entire part of the financial industry? And how long do we have until we get that to essentially blow up, right? And I don't think anyone's cheering for it to happen, but the writing's on the wall. So how long do we have? And then what is that catalyst that ultimately blows it up, do you think?
Risk happens fast, okay? You never think it's going to happen, and then all of a sudden it's all over you. But to be clear, I agree with you. I do not want this to happen, and I don't want it to happen fast. I believe in the long run, it will eventually happen. But what happens? What are the events? Well, let's be honest. The United States currency as global reserve currency today will be the last fiat currency to fail. Okay? That's just how it works. You can look in the credit default swap market. You understand that the US Treasury market's the biggest, the most liquid. It's got the most staying power. But what happens in credit markets is this thing called contagion. And what contagion essentially is what you've seen happen with Evergrande in China, and it percolating higher in the credit spectrum to where it's actually impacted the credit default swap rate or the expected default probability of the country of China. Okay, now China's credit rating is single A, but it's the credit default swap market is telling China, you know what? You're trading much closer to a triple B. You better get your acting gear, kid. Because you know what? A triple B credit is right on the cusp of being high yield or junk. And using the pejorative junk, I was a junk bond trader for many years. All it takes is a few downgrades into the junk spectrum, and there's a cascade of selling. And this cascade of selling then causes contagion into other markets. So China, being the second largest economy in the world, if all of a sudden the debt markets say, you know what, China, you're sort of ugly. You're a junk bond borrower equivalent. There'll be contagion to other economies. It's, even though, China would be a G8 country, absolutely, it'd be a G2 country, but it'll fall down the credit quality spectrum, something I call the risk ladder, and it'll impact countries like, Argentina, which is a G20 country, but it's defaulted 4 times in my life already. Now, I'm not predicting that I want to see this contagion, but that's what happens in credit markets, okay? One guy seeks protection by shorting another market, and that guy who's shorting that market causes a cascade of selling in that market. And it's just like we saw in the great financial crisis, okay? It starts to accelerate. The second derivative is the most important. Okay, the acceleration of the change will cause, am I saying this? A US Treasury bond auction to fail? Highly unlikely. But what about a Canada bond auction failing? Ooh, and Canada's a G7. Okay, so look, I don't want this to happen. And this is why we need this parallel network. We need to develop the Bitcoin safety net. We will have a Bitcoin store of value savings account, and we will have a fiat currency checking account. But don't save your money in a fiat currency checking account.
So when you think about all these pension funds and financial institutions that are holding so many bonds, what happens when they all drop it? Is that the acceleration you're talking about? Do they start to say, hey, look, there's 14% inflation based on the old calculation. There's 5% on the new calculation. I can't possibly continue to hold these treasuries because I'm actually losing purchasing power and not protecting my assets. I have a fiduciary responsibility to protect these assets. So I've got to get into some other asset. Does that just accelerate everything? Once one starts to do it, they all start to do it?
Yes and no.
Okay.
These are investment mandates that have been written over time. There's investment policy committees. These things don't change on a dime, Pomp. Now, maybe the smart people are sitting there, much like the Houston Fire Department or the guys in Chicago, if you haven't heard of them, the blue collar Bitcoin team that is a bunch of first responders in Chicago who are very concerned that their pension plan owns a certain number of fixed income securities because it's in their investment policy guideline. I mean, if the pensioners rise up and say, what are you holding these things? You're guaranteed to lose money. on a real basis, maybe it percolates to the investment policy committee. But remember, these investment policy committees are dominated by people who want to cover their ass, right? They don't want to make these decisions. What happens, though, is if one person, a big fund, let's say CPPIB in Canada or CalPERS in the United States, says, you know what, this 60-40 model is pooched. I'm going to go 60-20 and then 20 in alternative assets that do include a certain amount of Bitcoin. That really gets the ball rolling because it takes the pressure off of the theory of agents, they call it. You know, as long as one of the big guys moves in that direction, then I can cover my own investment policy decision.
When you start to think about the timeline for this to occur, for them to all start trying to move capital because of this this mechanism, is this a 5-year, a 10-year, a 15-year thing? How long do you think it takes?
Yeah, it's a process. So some will move early and some will be the last. And as a Canadian, I can almost certainly guarantee you that the Canadian knuckleheads will be one of the last ones to move. Okay, so that pains me because, you know, Canada, we've sold all our in our central bank, we've sold all our gold. Canada does not have the safety net that the US does. We're not as big a country. Obviously, we don't have the vertically integrated and horizontally integrated economies that you guys do. Listen, it happens because out of necessity. Let's do some quick math. If CalPERS has an 8% return bogey, and it's a 60-40, mix, and 40% is in bonds, and those bonds, to be generous, are earning on average over their whole asset mix. Let's say it's earning 3%, right? So 3% times 40%, that's 1.2% they're getting in their whole portfolio from bonds. That means the 60% that's in equities has to earn the difference. 8 minus 1.2 is 6.8%. So 6.8% divided by 60% of the portfolio means equities have to return 10% forever going forward in order for CalPERS to make their bogey. I don't know. Like, you know, yeah, there are going to be some good years, but over time, you don't hit that 10% bogey, especially when you're at all-time highs in the S&P, which you just pointed out. So there's a lot of stuff going on. It's absolute certainty. The mathematics of it, almost certainly unattainable. And if it is attainable, it's only because the fiat currency is pooping the bed so bad that it appears that your equity markets are actually going up when in fact, it's just the unit of account is going down, right?